Let's go to James Garish. He is from Shaw and Partners and author of Market Matters, and he's going to run us through his thoughts ahead of this Australian Open. James, can we start with Fisher and Paykel? I mean, it shouldn't come as a surprise that we're seeing a company like this flagging supply chain impacts of freight costs in particular. How negative is this in your view?
Yeah, good morning to you, Nadine. It is going to be a negative reaction from the market this morning, I would imagine. Just in terms of costs and supply chain issues, that's correct. But there's also a downgrade in terms of full year revenue, so that's top line sales. So they're saying that they're going to meet operating revenue of 1.68 billion to 1.7. So at the midpoint, that's 1.69. The market was at 1.76, so it's about a 4% downgrade at the top line, and then you'll have more of an impact in terms of the profitability. So you're looking at something like a 6 to 7% impact on earnings for the full year. So I'd expect the market to take that on a negative stance this morning, Nadine.
Look, but Fisher and Paykel is not alone. I mean, in the healthcare space alone, we've got ResMed also warning, of margin impacts because of the increased costs of shipping product around the globe. So again, why is this a surprise, and how can the market, readjust for the reality that is continuing supply chain disruption?
Yeah, so I mean, it's a surprise because the market estimates what the impact is going to be, and if they, if they're a little bit not as aggressive in their estimations, then obviously some adjustments need to be made, and that comes in the form of share price decline. So obviously, when a stock like Fisher and Paykel, it's trading on around 40 times earnings, and those, the top line is declined year on year, so it's going to be lower in FY22 than it was in FY21. So those are lofty multiples for a business that I know that they're being impacted by all these external issues, but it's true that they are declining in terms of their top line, and that's having a bigger impact on earnings. So the market makes estimations. Often we get it wrong. We're either too bearish or too bullish, and that's when you get share price reactions. A change of what the reality actually is. So today, I think that adjustment will happen on the downside for Fisher and Paykel. You made mention of ResMed. I mean, they're in a similar boat. They're trading on a really high valuation, not to the heights that Fisher and Paykel are. But again, they have they've pulled back. The market's readjusted their share price in line with those challenges from a supply chain issue. But I think they're probably doing a slightly better job than FPH has done this morning.
How do you feel about the healthcare sector overall right now, while we experience these volatile markets where it's risk on one day, risk off the other? I mean, do you like the defensive characteristics of healthcare?
Yeah, there's a couple of push and pull factors in the healthcare space. So on one hand, they've got really defensive earnings, notwithstanding the downgrade that Fisher and Paykel has had today. On the other hand, they trade on lofty PEs, so they're higher valuation type growth names. So higher interest rates are a negative for the sector overall. So it leaves you sort of it leaves you sort of neutral the space. So we're not big healthcare bulls nor big healthcare bears at this stage. Across the Market Matters portfolios, the only exposure we've got, and we've bought it recently, was CSL. So I should say ResMed as well in our growth portfolio. So we've got some exposure to healthcare, not a big bullish bet, but certainly not a big bearish bet either.
Okay, now what else are you watching as we head toward this open here in Australia? Obviously a positive night on Wall Street, but commodities, energy did come off the boil a bit. What kind of an impact do you expect that to have?
Yeah, expecting BHP to open down about 2.7% this morning. It was, of course, very strong in the market yesterday. It was up 5.1%. And interestingly, it added about 35 index points to the ASX 200 yesterday, which shows how much of a big index influence that stock is. So, resources to come under a little bit of pressure. Interesting overnight to see that the Nasdaq outperformed. It was up nearly 2%. outperformed the other more industrially focused indices, even though bond yields really kicked up. So, you know, the 2-year bond yield in the US is at 2.16%. It's up over 200% in the last 3 months alone. The US 10 years nearly at 2.4%, up about 60% in the last 3 months. So interest rates going up, but technology has still managed to rally. So that tells me that the market's very underweight tech, and you get some less bad news around tech, then the market tends to buy it irrespective of what interest rates are doing in the short term, Nadine.
Yeah, tech has been an interesting one. You know, yes, what happens in the US, even in spite of interest rate hike calls, 50 basis points is very much on the table in the upcoming meetings, but also China tech, you know, staging this huge comeback, Alibaba enhancing its share buyback. But it's not apples for apples when you look at overseas tech and the local infotech sector. So again, how do you look at investing in that area of the market? Do you buy the dip? Do you trim positions? You know, it's sort of a bit of it's a live conversation.
Yeah, absolutely. So, you know, higher interest rates are obviously the thing that everyone's talking about as a headwind for the technology space, but I think that's been built into the market. You look at the investor surveys and it shows that, you know, portfolio positioning towards tech is at around 16-year lows. So that to me leaves room on the upside. Asia tech is a little bit, you know, Asia tech is right at the edgy end of the space. So you made mention of Alibaba. You know, it's up nearly 50% in the last week alone. They up-spec their buyback. But if you think about Alibaba, it's a stock that's trading on, you know, about 3 years ago it was trading on 7 times revenue. It's now trading on about 1.4 times revenue. If you look at an earnings multiple, it's trading on around 15 times earnings, and they're growing those earnings at 15 to 20%. So they've got 46 billion in cash, and they're doing a $25 billion buyback. So, and I think there's some other Asian technology companies that will do similar. So to me, that looks like a standout buy, even though it's rallied 40% in the last week or so. Aussie tech is a little bit different, as you may mention of, but there's still some great technology companies that have got pricing power. So pricing power is important when interest rates and inflation and all of those things are on the up. And I'd highlight Xero as a stock that's got, or a company that's got really strong pricing power across their accountancy network. So, you know, if they increase their prices, they wouldn't lose a lot of customers as a result of that. So Xero around $100 is to me one of the standout buys in the Aussie tech space. That's large cap, that's you know, defensive earnings stream, and has got, you know, clearly pricing power.
Yeah, okay. Xero comes up in a lot of conversations these days as well. James, the banks. Now, I know you pride yourself on being a bit of a contrarian, but, you know, in this rising interest rate environment, do you think that the banks are a good place to be?
So I'm a sort of a short-term bull on the banks going into April. Obviously, bank dividends are being paid. They often find their way back into the banking stocks. So 3 of the big 4 banks go ex-dividend. You made mention of rising interest rates are a positive, but on the flip side to that, there is a flattening of the yield curve. So short-term, the short end of the curve is rallying a lot quicker than the long end of the curve. So that is actually a negative for banks. Banks, in a simple way to look at a bank borrows short and lends long. If the short end of the curve is rising greater than the long end of the curve, their margins remain under pressure. So I know we've had low interest rates are a headwind for banks. Rising interest rates are going to be the saviour, but now we've got a flattening yield curve. So that's just, you know, I think the asset quality is fine in banks. I think their balance sheets are great. So look, I'm a short-term bull. We own the banks. I'd be on the buy side leading up for the next month or so, but then we'd be looking to trim holdings. So I think this is going to be a lot more volatile year ahead, and we need to be active around our allocation. So that's how we'd be playing the banks at this stage, Nadine.